So, imagine checking your bank account one morning, right?
Okay.
And the balance hasn't dropped by a single penny. Like you haven't spent anything, you haven't made any bad investments or whatever.
Right. Your emergency fund is just fully intact.
Exactly. But then you go to the grocery store or, I don't know, try to pay your rent, and you realize your money suddenly buys like 10% less than it did literally the day before.
Yeah, that's brutal.
It is. You didn't lose any physical cash, but you are tangibly poorer, and that's the invisible theft of currency devaluation.
It really is a silent drain on your net worth. I
Mhm.
mean, most of us are kind of conditioned to watch out for standard inflation,
All right, just the slow creep of prices going up.
Exactly.
Mm.
But a sudden structural weakening of your local currency, that is entirely different. It's not just prices changing, it's the actual foundation of your purchasing power just sinking right beneath your feet.
Especially in emerging markets, right, where so many daily necessities are imported.
Oh, absolutely. Which
Well,
makes it a huge issue for a lot of people.
which actually brings us to today's deep dive. We are looking at this fascinating personal reflection document from an investor based in Indonesia.
Yeah, it's a really great source.
It really is. And our mission today is to extract the core insights from these notes to understand how holding foreign currency, specifically the Singapore dollar or SGD, functions as a hedge against that invisible theft.
Right.
We're going to explore the actual mechanics of currency diversification and see how it serves as basically a profound psychological safety net for you.
And setting the context for this source material is super vital here because, when the financial media talks about foreign exchange, the imagery is usually hyper aggressive.
Oh, yeah. You picture like high frequency retail trading.
Exactly. People using massive leverage betting on these volatile currency pairs.
Wedding in front of 6 monitors.
Right. Just trying to squeeze a margin out of a fraction of a cent movement between like the euro and the yen.
Yeah, the speculative side of the market where day traders are just trying to generate income.
Yeah. But this document is the exact polar opposite of that.
Completely.
These notes were written by and for everyday people. We're talking working professionals, young families, beginner investors.
People whose daily financial lives are tethered to a specific local economy.
Exactly. This is about personal treasury management, not speculation. It's about practical, accessible financial resilience.
So, the author of our source makes a really big point of addressing how their mindset actually had to shift to reach this conclusion.
Yeah, they had to unlearn a few things.
Right. Like, they admit they used to view foreign currency purely as a transactional tool.
Just vacation money, basically.
Yes, you exchange your local currency because you need to physically buy a souvenir across a border.
Right, right.
But as they started looking for ways to protect their wealth, moving beyond just holding physical assets like gold, they began treating foreign currency as a strategic shield.
Which is a huge mental leap.
It is. They realized holding the Singapore dollar wasn't about facilitating a transaction anymore. It was a way to quarantine a portion of their purchasing power away from the volatility of the Indonesian rupiah.
And that shift from a transactional mindset to a treasury mindset changes literally everything. I mean, when you view foreign money only as a medium of exchange, you only hold it temporarily.
Right, you convert it, you spend it, and you're done.
Exactly. But holding it as an asset class, that's closer to, well, securing a second passport.
Oh, I love that analogy. Let's unpack that. It's like you aren't getting that second passport just because you want to take a fun trip.
No, you get it to secure options.
Yes.
It gives you a legally and economically separate fallback position if, things go wrong at home.
And that separation is just key to a defensive financial strategy. The author's really explicit that their goal isn't to generate a yield on the Singapore dollar or trade it for profit.
Because for a professional with a full-time job and a family, day trading introduces way too much unacceptable risk.
And it just takes too much time.
Right. Using currency defensively means preserving the energy you've already expended to earn that money.
You're taking the economic value you produced in Indonesia and storing it in a vessel that isn't vulnerable to the same macroeconomic shocks.
But, and this is crucial, that vessel really matters.
Oh, for sure. Putting your money in a highly volatile foreign currency would just defeat the whole purpose.
Exactly. So we need to evaluate the safest, most effective vessel for this specific investor. I mean, there are over 100 recognized currencies globally.
Yeah, and the author deliberately bypassed the world's major reserve currencies. They specifically chose the Singapore dollar.
They outline 3 distinct reasons for this, actually. Perceived stability, geographic proximity to Indonesia, and realistic regional access.
They wanted an asset that matched the reality of their life in Southeast Asia.
Right.
But wait, I want to push back on that logic for a second, because to me, it seems counterintuitive for a beginner looking for maximum safety. Well, if the goal is absolute stability, right, and escaping local market volatility, why wouldn't you just default to the US dollar?
The global reserve.
Yeah, commodities are priced in it. It's the ultimate safe haven. Choosing the Singapore dollar instead feels like, I don't know, moving your money to the house next door when you could be moving it to a fortress across the ocean.
That's a fair point.
Hmm.
It does seem counterintuitive until you look at how local economies actually function for the people living in them.
Okay, walk me through that.
So, for someone in Indonesia, the United States is kind of an abstraction, but Singapore is a tangible daily economic reality.
Because it's the primary financial and medical hub of Southeast Asia.
Exactly. If an Indonesian family faces a complex medical emergency, they are highly likely to travel to Singapore for specialized care,
Right.
or if they want to send their kids to a regional university or run a business relying on regional supply chains, those transactions are heavily anchored in SGD.
Okay, so the actual utility of the currency plays a massive role in its defensive value.
Yes.
If a crisis hits and you need to deploy your emergency funds immediately, having US dollars sitting in some offshore account might introduce, like, conversion hurdles.
Exactly. It might be slow or complicated to access.
But having Singapore dollars means you hold the exact currency required to access the premier regional services right in your immediate geographic sphere.
The author calls this having realistic regional needs. A US dollar account might offer theoretical global stability, but an SGD account offers intense practical utility.
It acts as a localized anchor.
Right. It's accessible enough to be deployed quickly in an emergency, but structurally independent enough to provide macroeconomic balance.
Okay, wait, let's dig into that structural independence for a second, because this is where the regional argument feels a little bit fragile to me.
Okay, let's hear it.
Singapore and Indonesia are massively linked economically, right? They are huge trading partners.
Very much so.
So, if the Indonesian economy crashes, or if there is a severe regional crisis in Southeast Asia, wouldn't that just drag the Singaporean economy and, by extension, the Singapore dollar down with it?
It's a really valid question.
Like, how is the house next door a safe harbor if the whole neighborhood catches fire?
That is basically the most critical mechanical question to ask when setting up a regional hedge. And the answer lies in how Singapore manages its monetary policy, which is actually super unique.
You need how?
Well, the Monetary Authority of Singapore, the MAS, they don't use interest rates to manage their economy like the U.S. Federal Reserve does.
Right. Really?
Yeah, they use the exchange rate instead. They manage the Singapore dollar against a secret, trade-weighted basket of currencies from all their major trading partners.
Oh, wow.
It's known as the nominal effective exchange rate.
Meaning the value of the SGD isn't just floating freely and it isn't pegged solely to the US dollar or the rupiah.
Correct. By managing the currency against a diversified global basket, the MAS effectively insulates the SGD from the volatility of any single neighbor.
Yep.
Even if Indonesia experiences a severe downturn, the rupiah only makes up a fraction of that trade-weighted basket.
Because Singapore is a global financial hub processing capital from Europe, China, the US.
Yeah, exactly. Its currency is heavily buffered by that global exposure. So, for the Indonesian investor, the SGD provides the perfect hybrid. It's regionally local for practical access, but globally insulated to protect purchasing power.
Okay, that makes perfect sense. Which brings us to the mechanics of how this protective shield actually operates in real time. We've identified the right vessel, but how does the math of purchasing power preservation actually work when the markets start moving?
Right, the actual experience of it.
Yeah. The source material details a really visceral memory from the author. They describe watching their local Indonesian economy face heavy headwinds. The rupiah was weakening significantly.
And when a local currency weakens, the effects are immediate.
They really are.
Since emerging markets import a lot of basic commodities like fuel or wheat, and those are priced in US dollars, a weaker rupiah means it costs more rupiah to buy the exact same amount of oil.
And that increased cost just gets passed right down to the consumer, driving up local prices.
Yes, and the author felt that pressure. Their locally denominated savings were rapidly losing their ability to buy the goods they needed just to survive.
But then they looked at their Singapore dollar holdings. And this is where the inverse relationship of a hedge really proves its worth.
Exactly.
Because the rupiah was dropping in value globally, and the Singapore dollar was remaining stable through that MAS monetary policy, the relative value shifted.
Mathematically, it takes more rupiah to buy a single Singapore dollar.
Hmm.
So if the author were to convert their SGD back into local currency during that downturn,
They would receive a significantly larger amount of local currency than they originally put in.
precisely, their local savings were bleeding purchasing power, but their foreign holdings were simultaneously swelling in local value.
It's kind of like how a large ship uses ballast tanks to navigate rough seas.
Oh, that's a good way to look at it.
Yeah, think about it. If all of a ship's cargo is piled high on the main deck, representing all your wealth sitting in one local currency, the ship is top-heavy.
Right, very unstable.
Exactly. A sudden economic wave will just capsize you. But buying foreign currency is like pumping heavy seawater deep into the ballast tanks in the hull.
It doesn't make the ship go faster.
Nope, it isn't an engine for growth, but it artificially lowers your center of gravity.
So when the local economy pitches violently to one side, that ballast counteracts the momentum, keeping the ship upright.
That mechanical analogy perfectly illustrates the concept of hedging, I think. Financially, hedging is simply establishing a secondary position designed to offset potential losses in a primary position.
By holding SGD, the author artificially lowered the financial center of gravity for their entire household.
Which is amazing. But I'm curious about the logistics of actually executing this. Like, how does an everyday person in Southeast Asia actually pump water into that ballast tank? We aren't talking about storing stacks of physical cash under a mattress, right?
No, definitely not. Physical cash introduces theft and degradation risks, plus you get terrible exchange rates at physical money changers.
So what do they do?
Today, retail investors use multi-currency bank accounts or global digital treasury platforms.
Oh, like apps on your phone.
Exactly. These allow an individual to convert rupiah to SGD instantly through an app. However, there is a cost to doing business.
Always.
Banks and platforms charge a spread, which is just a slight markup on the exchange rate plus potential holding fees.
So you are taking a slight guaranteed loss up front on the spread just to secure the currency.
Yes, but think of that spread as an insurance premium.
Ah, okay.
You pay a small, known cost today to avoid a catastrophic unknown loss tomorrow. You are paying for the ballast.
That makes total sense. And the author notes that when they saw this ballast working, when they watched their SGD gain value against the rupiah, they didn't necessarily feel wealthier.
No, they just felt profoundly calm.
Yes, they realized they were prepared for the uncertainty.
And that psychological realization is arguably way more important than the financial math.
Really?
I think so. We talk a lot about ROI, return on investment, right?
Sure.
Well, the author introduces what we might call the sleep dividend.
The sleep dividend, I love that.
The dual nature of hedging becomes incredibly clear here. Yes, the math ensures your purchasing power remains stable. But the secondary effect is the total removal of panic.
And panic is the great destroyer of generational wealth.
Without question. Behavioral economics shows us that humans are just terrible at assessing risk during a crisis.
You really are.
When people watch their local currency devalue, they feel trapped. And that fear drives irrational, highly destructive financial decisions.
Like, they might sell off local real estate at rock-bottom prices just to get their hands on cash.
Exactly. Or they might liquidate retirement portfolios and eat massive tax penalties.
Or hoard physical goods unnecessarily, which actually drives local inflation even higher.
Right. But by holding a regional anchor like the SGD, you buy yourself emotional distance from the crisis.
You insulate yourself from your own worst instincts.
You have the clarity to just sit on your hands and do nothing while everyone around you is making fear-based mistakes.
The peace of mind the author explicitly mentions isn't just a byproduct of the strategy, is it?
No, it is the strategic advantage itself. Rationality during a crisis is an incredibly rare and valuable asset.
But, acknowledging that local crises happen brings up this complex emotional hurdle that I think stops a lot of people from ever implementing a strategy like this.
The guilt factor.
Yeah. If you are actively hedging against your own country's economic stumbles, there is this lingering sense of guilt.
The feeling that you are somehow betting against the home team.
Yes, exactly. If I am an Indonesian citizen living and working in Jakarta, and I am converting a chunk of my salary into Singapore dollars to protect myself against the rupiah falling, am I being unpatriotic?
It feels inherently pessimistic to some people.
Right. It implies I think my government is going to fail, or my country's economy is doomed. The author's notes have to tackle this because it's a massive mental block for any beginner investor analyzing their own relationship with their home country.
They do tackle it head-on, actually. The author insists that holding SGD is definitively not a sign of pessimism toward Indonesia or the rupiah.
Okay.
They are not hoping for an economic collapse just so their foreign currency appreciates. They separate national identity from personal risk management.
That's a good way to frame it.
They view currency diversification and the fundamental law of general financial resilience.
The author actually uses a specific phrase that serves as the thesis for their entire strategy. They say, not all assets must depend on a single currency.
It's a phenomenal distillation of risk management.
It really is. If we pull from systems engineering, this is the exact definition of engineering out a single point of failure.
Absolutely.
In any complex system, whether it's a software network, an airplane, or a power grid, a single point of failure is a node that, if compromised, brings down the entire system.
Right.
No engineer would ever build a commercial jet with only one computer system controlling the rudders.
Never.
It doesn't matter how optimistic they are about the quality of that computer. Optimism doesn't prevent power surges.
And applying that engineering principle to personal finance reveals just how fragile the average person's setup truly is.
Oh, it's scary.
Think about a standard financial profile. Your monthly salary is paid in your local currency.
Right.
Your emergency savings account is held in that same currency.
Uh-huh.
Your retirement portfolio is likely heavily weighted in domestic stocks. And your physical real estate is priced in the local market.
So literally 100% of your net worth is tied to the monetary policy of a single central bank and the political stability of a single government.
That is a massive structural single point of failure. If that one currency experiences a shock due to, say, a global commodity crash, political instability, or severe inflation, your entire financial foundation fractures simultaneously.
Your salary buys less, your savings erode, and your domestic portfolio plummets all at the exact same time.
Embracing the author's philosophy means actively designing that single point of failure out of your life.
By utilizing a multi-currency account to hold something like the Singapore dollar, you are decoupling a portion of your survival capital from your local geography.
Yes, acknowledging that local conditions could worsen isn't unpatriotic pessimism. It is basic, responsible engineering.
You can be incredibly bullish on your country's long-term economic future, actively invest in local businesses, vote in local elections, and still build redundancy into your own household's financial system.
Redundancy is the ultimate goal here. You are shifting from a fragile financial stance where any local shock devastates you to a robust stance where local shocks are painful but survivable.
Diversification isn't an expression of doubt. It is the architecture of resilience.
Well said.
Well, we've covered a tremendous amount of ground in this deep dive, extracting a highly sophisticated treasury strategy from a set of personal reflections.
We really dug into it.
We started by dismantling the idea that foreign currency is just transactional travel money, redefining it as a defensive asset class used to quarantine purchasing power away from local volatility.
We then explored the critical importance of selecting the right vessel, examining why an everyday investor in Southeast Asia benefits way more from the tangible regional utility of the Singapore dollar than the abstract global dominance of the US dollar.
We looked at how Singapore's trade-weighted monetary policy structurally insulates the SGD from neighboring economic crashes.
And we broke down the mechanics of the seesaw effect, how holding that foreign currency acts as ballast in the hull of a ship, keeping your net worth upright when local markets pitch violently.
And we highlighted how the true return on that investment isn't just financial parity, but the sleep dividend that prevents panic-induced mistakes.
Finally, we confronted the emotional hurdle of patriotism versus pessimism, reframing currency diversification as the necessary engineering of removing single points of failure from your financial life.
Which leaves you, the listener, with a personal audit to conduct. Look closely at your own financial architecture. Where are your single points of failure?
It's an important question.
Are your emergency funds, your income streams, and your investments entirely dependent on the health of just one local economy or the policy of one central bank? If they are, what does your version of the ballast tank look like?
What regional or structural anchor could you realistically implement today to begin building that defensive wall?
Assessing those single points of failure is probably the most valuable action you can take.
It really is. And, to push your thinking even further, consider how the very definitions we've relied on today might actually evolve.
Oh, how so?
Well, we've spent our time discussing the strategic value of diversifying across different national currencies, using one government's money to hedge against another government's money.
Okay.
But look at the rapid maturation of decentralized finance, borderless digital assets, and global e-wallet ecosystems.
Ah, okay.
If the ultimate objective is simply to preserve purchasing power across borders without relying on a single central bank, how might the rise of stablecoins or algorithmic digital currencies completely redefine what constitutes foreign or local money in the next decade?
That's a massive question. The mechanisms of hedging might look radically different when the concept of a border is removed entirely from the currency.
Exactly. That structural shift could change the entire landscape of personal treasury management.
Definitely something to mull over. Well, until next time, keep digging, keep analyzing your systems, and we'll see you on the next deep dive.